In this video we are going to talk about dividend stocks to buy and hold forever. So before starting, please like this video and subscribe to this channel for future updates. What's the simplest method to boost your investing profits? Hold on to your investments for as long as you can. This is particularly true when it comes to dividend stocks. Dividend reinvestment over a lengthy period of time may greatly increase your overall returns. However, if you want to keep for a long time, you'll want to be more careful about the stocks you purchase in the first place. Here are 3 dividend stocks that you can purchase now and keep for the rest of your life. Number 8. Exxon Mobil. Exxon Mobil (XOM) is the world's biggest publicly listed oil and gas company, with a market capitalization of $331 billion. Since 1982, the firm has raised its dividend every year, the longest record in the energy sector, and it has paid consistent or increasing dividends since 1956. Exxon Mobil is the largest of the oil and gas supermajors. Exxon Mobil can trace its roots back to Rockefeller's Standard Oil via a bewildering variety of spin-offs, mergers, and acquisitions. Exxon Mobil is in many respects the successor to Standard Oil, as the world's biggest publicly listed oil corporation. When one considers the cyclicality of the oil business, Exxon Mobil's history of increasing dividends is particularly impressive. The earnings of Exxon Mobil are determined by the price of oil. The company's business strategy is sufficiently diverse across upstream, downstream, and chemical that it can maintain its dividend even when oil prices are low. When oil prices aren't too low, Exxon Mobil's upstream sector is by far the biggest. The upstream sector is responsible for oil exploration and production. Oil refining is carried out in the downstream sector, whereas chemical manufacturing is carried out in the chemical segment. In the most recent quarter, the company's profits were broken down by section as shown in the graph below. Number 7. Costco. Costco was established in 1983 in Seattle. It has now expanded to produce $139 billion in yearly sales, and a market capitalization of $99 billion. Costco has paid growing dividends for 14 years in a row, having increased its payout every year since its inception in 2004. Costco is mainly based in the United States, although it also includes sites in Canada, Europe, and Asia. While Costco has a long dividend history, it pales in comparison to several of the older businesses in this article. Despite this, the business remains a dividend achiever, 10+ years of increasing dividends. What stands out about Costco is its phenomenal business model. Costco's profit margins are razor-thin. It runs its cheap shops on a virtually break-even basis. The majority of the company's revenue comes from yearly subscriptions. Memberships accounted for about 71% of the company's operational revenue in the first 3 quarters of fiscal 2018. The company's membership numbers are impressive. 90% of customers renew their contracts, an exceptionally high number. A total of 50.9 million households. Total cardholders, 93.0 million. Costco's success is built on its unique business strategy and emphasis on passing savings on to consumers. And the business has done well. From 2008 to 2017, earnings per share increased by 8.1% annually, including the Great Recession low of 2009. Costco's earnings per share dropped by just 11% in 2009, demonstrating the company's resiliency in a tough economic climate. Number 6. Dwight & Church. Church & Dwight, CHD, was established in 1846, and has a market capitalization of $13.7 billion. As a result, the business is smaller than some of the consumer goods industry's behemoths. The following are some of the company's major competitors. Procter & Gamble, PG, has a market capitalization of $207 billion. Unilever, UL, has a market capitalization of $168 billion. The market capitalization of Colgate-Palmolive, CL, is $58 billion. While Church & Dwight is not the biggest company in its field, it has been one of the most successful in recent years. It also has a number of brands that are expected to last for a long time and function effectively regardless of the state of the economy. Arm & Hammer is the company's initial power brand. Church & Dwight has grown beyond Arm & Hammer to include well-known brands such as Trojan, Orajel, and OxyClean. More of the company's well-known brands may be seen in the picture below. Church & Dwight has wisely exploited its brands. The business has utilized these cash flows to both extend the reach of its own brands and to purchase additional high-quality brands. From 2008 through 2017, Church & Dwight's earnings per share compounded at a rate of 11.6% each year. Earnings per share growth of around 9% each year is expected to continue. Number 5. Abbott Laboratories. Abbott Laboratories, NYSE, ABT, is a dividend aristocrat, having increased its dividend for 49 years in a row. Fortune's top 50 most admired companies list includes the firm. For the last 8 years, it has ranked first in its industry. Those are some very amazing honors. It's much more essential, however, that Abbott be the market leader in all of its companies. Abbott is the industry leader in cardiovascular care, diabetes care, diagnostics, and nutrition. To be fair, Abbott's dividend yield of 1.4% is unlikely to tempt you. However, the payout is virtually likely to increase with time. Abbott should also produce significant sales and profits growth, which should lead to substantial stock price gain. The Freestyle Libre continuous glucose monitoring gadget and the MitraClip mitral valve are major growth drivers for the business. COVID-19 testing revenues may decrease, but they should continue to be a significant source of income long after the epidemic is over. Over the next decade and beyond, Abbott's dedication to innovation will almost certainly result in new products and markets. Number 4. Brookfield Renewable. Brookfield Renewable, NYSE, BEP, NYSE, BEPC, does not have Abbott's dividend hiking track record. However, during the past 2 decades, the business has grown its dividend payout by a compound annual growth rate of 6%. And, with a yield of almost 3%, it is likely to appeal to the majority of investors. Brookfield Renewable, on the other hand, has one thing in common with Abbott. Its dividend is less appealing than its growth potential. Nearly 130 countries have committed to achieving net zero carbon emissions. Nearly 3,100 companies have pledged to reduce their carbon emissions by half by 2030. Brookfield Renewable, which is one of the world's top renewable energy suppliers, sees this as a tremendous potential. Over the long run, Brookfield Renewable aims to produce total returns of between 12% and 15%. The business should be in a good position to meet that objective, given the growing demand for renewable energy and its vast development pipeline, which is set to deliver substantially more capacity. Number 3. Johnson & Johnson. Few businesses can match Johnson & Johnson's illustrious history, NYSE, J&J. With 59 straight years of dividend growth, it's a dividend king. On Fortune's most admired firms list, J&J is ranked first among pharmaceutical companies. It is the world's biggest healthcare corporation. Johnson & Johnson is one of the most reliable companies around. Approximately 70% of its revenues originate from items that are ranked first or second in their respective markets. The business has 28 products or platforms that produce over $1 billion in yearly revenue. It's also a deceptively agile behemoth. Over the past 10 years, the business has produced an annualized total return of 13.1%. Around a quarter of its overall income comes from items introduced in the last 5 years. J&J should be able to maintain steady profit growth in the long run. Add in the company's appealing dividend, which is presently yielding about 2.8%. You'll almost certainly never regret investing in this blue-chip dividend stock. Number 2. 3M. Number 2. 3M only Boeing, BA, has a higher market value in the industrial sector, with a market cap of $121 billion. Since its inception in 1902, 3M has seen steady growth. Furthermore, the business has paid rising dividends for 60 years in a row and has paid dividends for more than 100 years in a row. 3M's stability and success are due to the company's focus on research and development as a source of innovation. In fiscal year 2017, the business spent $2 billion on research and development, 6% of total revenues. At 3M, innovation pays well. The firm generates 30% of its sales from items that didn't exist 5 years ago. 3M's production profile is extremely diverse, in addition to its emphasis on innovation. The business is divided into 5 parts. Number 1. McDonald's. Since its founding in 1955, McDonald's, McD, has been the uncontested king of the fast food business. It's difficult to exaggerate how successful McDonald's is in comparison to its competitors. The market capitalization of McDonald's may be compared to that of its competitors to get a sense of the company's size. McDonald's has a market capitalization of $126 billion. Yum Brands, YUM, is its next largest rival, with a market capitalization of $27 billion. McDonald's has a market capitalization almost 5 times that of its nearest rival. McDonald's also has by far the greatest dividend history in the restaurant business. Since its inception in 1976, McDonald's has paid increasing dividends every year. The firm has a business plan that is recession-proof. It might be claimed that during recessions, McDonald's does better. Because individuals substitute down during recessions, this is the case. When money is tight, a family that would go to a mid-tier restaurant in good times will instead go to McDonald's. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thanks for watching.